Hello everyone and welcome to our detailed overview of central banks. A central bank is a key player in an economy, functioning as the republic's monetary pivot. As such, it plays a major role in influencing economic activity and ensuring a stable financial system. This explanation will extensively cover various themes related to central banks, including their roles, administered aspects, monetary policies, and interest rates. Central banks ascertain the quantity of money circulating in an economy. They do this by conducting operations in the money markets, influencing interest rates, and using different tools to adjust the quantity of money in circulation. Therefore, central banks occupy a crucial place in any country's financial system. One of the significant sectors managed by a central bank is the financial sector. Central banks have to ensure that financial institutions are functioning correctly and are adequately capitalized. They help regulate banks, supervise them, and oversee their actions to maintain financial stability. Central banks are also responsible for determining and executing monetary policies. Agreements with the government enable central banks to influence money supply, using tools like open market operations, reserve requirements, and discount rates. Such initiatives seek to modify inflation rates, stabilize exchange rates, and boost the overall economy. Open market operations, for example, provide a way for the central bank to adjust the money supply. It may involve buying or selling government securities in the open market. If the central bank purchases these securities, it provides the commercial banks with additional reserves to lend, thereby pushing the money supply upwards. On the other hand, reserve requirements mandate that commercial banks keep a specific percentage of their deposits as reserves. By changing this percentage, the central bank can control the amount of money that commercial banks can lend out. It affects currency expansion or contraction and ensures economic stability. Lastly, discount rates are the interest rates at which the central bank lends to commercial banks. By modifying this rate, the central bank can influence the number of reserve funds commercial banks hold and, consequently, the volume of currency circulating within the economy. Banks make decisions based on these rates. For instance, during periods of low growth, a central bank may lower the discount rate to stimulate economic activity. Simultaneously, during robust economic periods, it might boost the discount rate to curb inflation and promote savings. Another central function of central banks is the issuance and management of a country's currency. While commercial banks facilitate most daily transactions, the central bank is responsible for printing money and controlling its overall distribution. It ensures that money supply and demand always balance, which is essential to maintain price stability and curb inflation. The continuous management of the exchange rate is another core element of a central bank's responsibilities. It is connected to the overall direction to achieve monetary and financial stability. A central bank can influence exchange rates by buying or selling excess reserves, creating a change in the supply or demand for the currency. Additionally, central banks help to manage the government's borrowing needs. Central banks can act as the government's banker and provide short-term financing by issuing securities or controlling the primary government securities market. They can also offer long-term loans to the government, which some consider a part of their monetary policy. Now, let's talk about monetary policy and the direction it takes. Monetary policy refers to the actions undertaken by a central bank to influence the availability and cost of money and credit to help promote national economic goals. These goals usually include stable prices and low inflation, moderate long-term interest rates, and maximum sustainable output and employment. At the heart of every monetary policy is a central bank's attempts to manage inflation and foster sustainable economic growth. A healthy rate of inflation is usually necessary for economic growth, but too high or too low an inflation rate can be problematic. Therefore, central banks usually aim for a modest and positive rate of inflation, generally around 2%–3% annually. In relation to economic growth, too rapid or too slow a rate of economic expansion can also be problematic. Central banks work to balance this by adjusting interest rates in the money supply. They lower interest rates and increase the supply of money to promote economic expansion. Conversely, they increase interest rates and decrease the supply of money to slow down an overheated economy. Low to moderate interest rates encourage borrowing and spending by consumers and businesses, and with the added money in the economy, there is an increase in demand for goods and services. Over time, this greater demand can lead to economic growth and declining unemployment rates. Conversely, high interest rates discourage borrowing and spending and slow down the demand for goods and services. As a result, economic growth tends to slow down, and unemployment may rise. This is particularly true for borrowing and spending related to housing, cars, and business investment and expansion. To successfully control monetary policy, central banks work hard to implement the right price signals and directives into the financial market. They inform on their upcoming changes in interest rates, and sometimes even on their outlook for the economy, and hence market participants, consumers, businesses, and investors can plan accordingly. Besides signaling, central banks also engage in direct interventions in the market, typically in the exchange rate markets. In this context, a central bank may, for example, buy or sell its domestic currency to create a certain level of exchange rate or impact the direction of movement. Central banks play a significant role in economic policymaking because of their potential impact on the financial markets. They have an important influence on the market interest rates through their control over the supply of reserves, and they use this power to implement their monetary policies. In conclusion, central banks play an integral role in a country's economy. They manage the money supply and interest rates, regulate the financial sector, ensure financial stability, and influence the exchange rate. They are significant economic policymakers and use a range of tools to achieve economic goals of growth, price stability, and full employment. They also interact with the government, often acting as a fiscal agent and providing financing to the government. Overall, the manifold roles and responsibilities of central banks reflect their importance to the economy and are indicative of the careful management needed to steer national economies towards prosperity. Not forgetting, it's imperative that central banks operate independently, thus allowing them to make decisions based on sound economic principles, instead of political pressures. Their objective is to ensure that economic growth remains stable and does not overheat, thereby maintaining a balance with the critically important aspect of inflation control. As we have seen, a variety of unorthodox measures can be applied, or an unconventional combination of techniques, to implement a monetary policy that not only targets a specific situation but also takes into account the interconnected global financial system. Besides interest rates, other methods like quantitative easing, where central banks purchase financial assets from financial institutions, with the aim of increasing the money supply and boosting lending and investment, have been used in the post-Great Recession period by many central banks. Similarly, central banks also rely on forward guidance, where they signal their expected path of monetary policy over some time intervals, thus providing clarity and predictability to the markets and the economy's stakeholders. In summary, central banks play a crucial role in each country's economic outlook. As national economic stewards, they manage currency, set official interest rates, protect financial stability, and oversee private and public financial institutions. They perform these duties through driving monetary policies, which aim to achieve price stability, economic growth, and financial stability. Moving forward draws a picture that central banking of the future is likely to be more challenging than ever before. Developments in digital banking and cryptocurrencies have prompted debate about the future of central banking and the role of the central bank in the future financial system. As the custodians of a country's wealth, central banks need to be at the forefront of understanding these rapid changes and harnessing the potential benefits. Simultaneously, they need to keep close to their mandate to ensure price stability, economic growth, and financial stability. Throughout the years, central banks' roles, policies, strategies, and operations have evolved to adapt to constantly changing economic environments and to stay effective. A significant challenge today is the likelihood that global economic shocks and crises will be more frequent and more severe. Adaptability and agility will be essential to cope with these challenges. Lastly, with an expanding and important mandate, it will always be a question on ensuring that the right professionals and capabilities are in place. This will also mean continuous rethinking and reshaping of the tools and techniques available to central banks to ensure they remain effective and credible in managing monetary and financial stability as the economic environment evolves. In this context, it's instrumental that central banks continue to strive for transparency and accountability, both in setting policies and maintaining financial stability. This way, they can build and maintain trust and confidence from the society in their actions. The rapid transformation in the economic and financial environment warrants a proactive approach from central banks. It is not only about the management of factors affecting the domestic economy, but it is also about understanding the global economic landscape and having the capacity to leverage these dynamics effectively and efficiently. Education and communication will continue to play an essential role in central banking. It is imperative that every stakeholder of the economy, from businesses and consumers to researchers and the media, can understand the rationale behind monetary policies and feel confident in the direction set forth by the central bank. In conclusion, central banks play a crucial role in the economy and have a variety of functions, including managing the money supply, issuing currency, regulating financial institutions, providing financial services, setting interest rates, and ensuring the stability and strength of the macroeconomic environment. As we move forward, the role of central banks will undoubtedly continue to evolve, along with the economic and financial landscape, as we embark on this ever-changing economic journey.